Hello everyone, welcome back to this exercise series for chapter 8 from our Managerial Accounting course, ACCT 428. In this video, we're going to be looking at exercise 8-5A. It says, use the standard price and cost data provided in exercise 8-1A, which is the first exercise we have solved for this within this series. Assume that the actual sales price is $11.76 per unit, and that the actual variable cost is $6.90 per unit. The actual fixed manufacturing cost is $3,000, and the actual selling and administrative costs are $1,230. So if you remember, we have solved a similar exercise at the beginning of the series, exercise 8-1A, where we had similar data, but the price was a little bit higher. The price per unit was $12 per unit, and the variable cost was also a little bit higher. It was $7.20. And I have taken part B of that exercise and I put it down here already, which was the flexible budget for a level of production of 2,200 units. So now what we need to do is create another actual budget based on the variances that we have in the price per unit, so from $12 to $11.76, and in the variable cost from $7.20 down to $6.90, and also the changes that occurred in the fixed manufacturing costs. It was 3,600, I remember, in the first exercise, and now it's only 3,000. And the actual selling and administrative cost as well changed. It was 1,200, and now it's increased to 1,230, right? So I copied the data from that exercise. Now we're going to add one more column. We'll call it actual price / cost at 2,200 units. Okay, that's the requirement here. And then we also need to classify the variances. In the second requirement, classify the variances as favorable or unfavorable. So we're also going to add one more column. We'll call it flexible budget variances. Variances. Okay. Now let's go ahead. For the sales, now we have a different price. This is our new price. Let me highlight it. Okay, so for 2,200 units at a price of $11.76, we should have sales of $25,872. Okay. For the variable manufacturing costs, we also have a new variable cost. The cost was down from a $7.20 per unit to $6.90. So 2,200 multiplied by 6.90. That means the variable cost is $15,180. Okay. That will give us a contribution margin of 25,872 minus 15,180. That's $10,692. Okay. Now the fixed manufacturing costs also decreased, as I said, from 3,600 down to 3,000. So we'll write that as it is, 3,000. And the fixed selling and administrative costs increased just slightly from 1,200 to 1,230. So we'll write that as well. Okay. Now we'll calculate the actual net income. 10,692. I already have that on my calculator, so I'm going to subtract 3,000 and also subtract 1,230. We should get a new net income of $6,462. Okay, and close the account. So that's part A. For part B, we're going to calculate the variances. So let's see what we have here. For the sales variance, 26,400 minus 25,872. That's a variance of, let's use a different color, $528. $528. Okay. The actual sales is lower than the budget, so that's unfavorable. So we'll also write the letter U. For the variable manufacturing costs, we'll calculate the difference between 15,840 minus 15,180. That's a variance of $660. $660. A decrease in the variable manufacturing cost, so that is a favorable variance. Okay. The contribution margin is, or the actual contribution margin is higher than the flexible budgets, so we'll calculate the difference as well here. 10,560 minus 10,692. That's a difference of $132 increase. 132. So the contribution margin, the actual contribution margin is higher than the budgeted one, so that is a favorable variance. The fixed manufacturing costs, the actual fixed manufacturing cost is lower than the budget by 600. That is also a favorable variance. The fixed selling and administrative costs is slightly higher, only $30 difference, but it's still higher, so that is an increase in the fixed cost, so that is unfavorable. Okay. Ultimately, the variance in the net income, 5,760 minus 6,462. That's a variance of $702. $702. And the actual net income is higher than the budget net income, so that's a favorable variance. Okay, let's just match the lines to make our answer a little bit more presentable and organized. Here we go. Okay, so that is the answer to parts A and B. In C, the question says provide another name for the fixed cost flexible budget variances. Now these are called spending variances. Okay, so we'll just put that in. Part C. Fixed costs flexible budget variances are alternatively called spending variances. Or you can just write spending variances right away. That would also be fine. Okay. Last part D, it says comment on the usefulness of the variances with respect to performance evaluation and identify the members of the management team who is or are most likely to be responsible for these variances. Now, this is a question that you would need to comment on based on your understanding in your own words, but I'll give you some indications. Notice what happened here. What happened is that the company had reduced the selling price, okay, from $12 to $11.76, and their variable costs also were decreased. So you're going to need to comment on that. Perhaps that was done intentionally. They wanted to lower their selling price to attract more sales, to increase their sales. And as you can see here, that resulted in less sales, okay, which is expected as a dollar amount. But because the variable manufacturing cost also decreased, okay, the company ended up with greater margins, okay? So the contribution margin in the actual scenario is higher than what was budgeted, okay? And who's responsible for this? Most likely, you could say that the higher sales resulted from the sales team of the company as a strategy. Also, the variable manufacturing cost, that would be the responsibility, or the reduction in the variable manufacturing cost probably resulted by actions taken by the production manager and maybe the purchasing team in the company. Okay, the fixed manufacturing costs also were reduced, which is a positive thing. That could be due to various reasons, from the management taking action to reduce the fixed costs in the production facility, maybe reducing electricity consumption or whatever that might be. And the increase in the sales and administrative costs is minuscule, but it could be a result of an increase in whatever consumption in the offices of the business that they might need, maybe an increase in the rent of the office space or supplies consumption or things like that. Okay, so you can put this in your own words. What's most important for a company in this scenario is ultimately their net income had increased. So they generated more net income than what they have budgeted for, which is ultimately a good outcome for the company. Okay. Now this is how you would solve an exercise similar to this, exercise 8-5A. I hope you found this video useful. If you have any comments, please feel free to drop them down in the comments. I'll try to answer any questions that you might have. And until I see you in the next exercise solution video, take care.